While the tariff war has escalated to historic levels, Beijing now appears to be capping its tariff retaliation and turning to non-tariff tools. Beijing's position was firm. Given that the current tariff level, there is no market acceptance for U.S. goods exported to China. If the U.S. continues to impose tariffs on Chinese goods exported to the U.S., China will ignore it.
Welcome to the Morning Markets and Metals with Vince Lanci, where each morning Vince brings you the financial and precious metals news to get you ready for your day. And now, here's Vince.
Good morning, everyone. I'm Vince Lanci, and this is the Gold Fix. So I need a little bit of music to warm up today. Okay, we'll come to this chart in a second. Let me get my act together here. There we go. All right, today, the headline is tentatively gold's logical destination after China's strategic shift. We'll talk about both aspects of that. China's strategic shift, that's the news, and gold's logical destination, that's the analysis in premium. Okay, let's start with the markets. 10-year yields are essentially unchanged at 442. The dollar is 99.80, taking the brunt of the news mostly last night, down 1. The S&P 500 is up 17 or 18. I think it's off its highs. Haven't looked in a little bit, 52.86. The VIX is 42.59, up about 2 percentage points or 4.5% in asset terms. Gold is 32.15, up $40 on its highs, almost on its highs. Silver, 31.48, well off its lows. It was negative for most of the night while people were buying gold, up 26. Copper is 442, up 6.5, 6.75. WTI is 60.33, down 4. Natural gas is 345, down 5. Bitcoin is 82,100, up 2,600. Interesting. Palladium 919, platinum 942, gold silver 102, up 2, up 8, up 39 basis points. Grains are all up again. Soybeans 1024, up 2 and change. Corn 478, up 2 and change. Wheat 557, up 10. That's pretty big. Okay. I'll just give you quick takes on this, more holistic takes. There was news last night, and the news would, in the pattern that we've had for the last 3 or 4 days, that would be bearish for U.S. bonds. It would be bearish for the U.S. dollar. It would be bullish for gold, and it would be bearish for U.S. stocks. So we have the dollar, as I said, taking the brunt of the news, and gold also digesting the news bullishly. 10-year yields are stable, and the S&P 500 is stable. Stocks I don't care about in terms of what's going on geopolitically. 10-year being stable is, I guess, as an observer, I'd say that's welcome, right? Okay. As a trader, I would put it on my radar that maybe we're about to do something domestically, like a QE, like an easing. I don't know. But that has to be on your radar now because this is the first time that China has done that. However, when you drill down into the news, which we will do in a second, it could be taken as the trade war, or at least the tariff escalation portion of the trade war, is stopping. And while American markets may view that as relief, I do not view that as relief for the escalating trade war, even though the tariff war may be on pause. It's not for good reason. Silver starting to catch a bid, started out negative. I think that's very constructive, right? Silver has to catch up because gold's money and silver is not in that respect. It looks like the economic aspect of silver is not working against it right now, but you also notice copper is up as well. So why are silver and copper up? Okay, gold's up. That's one reason silver's up. Another reason is China is about to stimulate, I think, in a very big way. And we'll discuss that in the China raises tariffs part, the story on the left. Also, the US may be getting ready to do something like ease or QE. So you may actually have simultaneous easing in China and the US. I'm not married to this concept. I'm just hatching it now. China eases to get its domestic demand going, and the US eases to stabilize its bond market. How would it ease to stabilize its bond market? We'll talk about that in a second. All right. Those are the three stories. Top center, that's Goldman's 4,500 outlier target. We focus on that right now for the second because there's a lot of options that they have sold to clients. And as a result, they are buying options to counteract it. And we're getting close to one of those strikes. That's the 3,300 strike. Top left-hand side, China raises tariffs to 125%. We'll talk about that presently. Here's the stories from last night. Okay, China is prepared to properly decouple this time. That's a Goldfix founder who gave his geopolitical take coming from Asia, Taiwan, Singapore, that area. And he thinks China is ready to decouple this time. That story was put out, written by him and put out by us before China's reaction, the China news today. So pretty good. Must read. We think this is a must read if you're trying to figure it out from a plumbing point of view, what's going on. The worst case scenario that we had described 4 days ago is here for markets in terms of the dollar going down with bonds going down. We also have a story for the founders. JP Morgan and Goldman Sachs senior traders said that when Trump backed off on the tariffs for 90 days, rolling it back, I think is the expression they used. Well, that was Trump blinking. And it's going to get different or maybe weird now, I guess is the way they would put it. A morning for the ages. That was yesterday's broadcast. Unlocked, Goldman Sachs. We talked about that already. And there's the ad. All right, so let's get to the analysis, right? Okay, yesterday, today, early in the morning, China's Ministry of Commerce put out a message. All right, at the top there, I want to read to you probably what we think are the most important headlines coming off of the teleprompt, the terminal. China no longer makes economic sense if the U.S. imposes more tariffs. China is to transition 200 billion yuan plan to support export to domestic sales transition. They're going to start selling things to themselves. They're going to expand their service sector, opening up pilot to 9 more cities, including Shenzhen. I cut off the last word there. China stock exchanges set daily restrictions on net share sales by individual hedge funds and big retail investors. And finally, that's my phrasing there. China is changing the status of U.S. chips to permit their import. Those statements there are everything you need to know about what China's doing. China's disengaging on the tariff escalation. Okay, you're going to put 1,000% tariff, 1,001, doesn't matter. We're not in reality anymore, right? We're just not going to trade with each other anymore, right? You can put it in 1,000,000,000%. We don't care. And then they say, you know what? We need to sell our stuff and we'll sell to our own people. And when you see the word pilot program, I didn't put the word pilot program in there. Oh, there it is. Here it is. When you see the word pilot program in China, that means it's already done. The pilot is the tombstone for the deal. The pilot program on insurance companies testing gold, it's done. It's a done deal, right? And then you make sure you use capital controls and you say you can't short. Okay? They didn't invent that. We did, right? And then you change status of the things that you want imported. There's a nuance there. I don't want to get too much into except to say that China does want U.S. chips, and so they have been doing their best to get around banning and unbanning. But I think what they're doing is they're trying to make sure that whatever's tariff that they need, they untariff it. Okay, so here's an excerpt for you. In a statement, the commission declared that China would, quote, no longer respond to any further tariff increases by the United States. This signals a clear tactical shift. This is us writing here. While the tariff war has escalated to historic levels, Beijing now appears to be capping its tariff retaliation and turning to non-tariff tools. Beijing's position was firm. Given that the current tariff level, there is no market acceptance for U.S. goods exported to China. If the U.S. continues to impose tariffs on Chinese goods exported to the U.S., China will ignore it, said the Tariff Commission. Now, quick side note. If it sounds like I'm cheering China, I'm reading their words, essentially, their statements. The bottom line is they're saying we're not going to escalate anymore, and then they raise their tariffs and walk away. It's a tactical thing in and of itself, but it's not to say you should take them as bluffing. Okay, the escalation phase of the bilateral war is effectively over. Continuing here, said Jiwei Zhang, president and chief economist at Pinpoint Asset Management. Quote, both China and the U.S. have sent clear messages. There is no point in raising tariffs further. The full breaking story with a little bit more meat on it is in that link right there. China raises tariffs to 125%, announces strategic shift in trade retaliation. That's news, right? And it will help you get an idea on what could drive market moves today, absent other news. Next, markets recap yesterday. Stocks ended lower as investors fretted over the economic impact of the ongoing tariff war. Shorter dated treasury yields dipped after strong dollar auctions eased demand concerns. That might be one of the reasons that the bond market is not getting crapped on this morning. I mean, it's creeping up, but it's not bad yet. Gold gained, supported by a weaker dollar. Oil fell as focus shifted to the intensifying trade tussle between the U.S. and China. Canada's main stock index fell in broad-based declines, coming off of previous sessions rally spurred by U.S. President Donald Trump's temporary tariff relief. The Toronto Stock Exchange's S&P TSX Composite Index closed 3% lower at 23,014. The full market recap, Wall Street Journal style, is at the bottom. Next, today's data. PPI is out today. There will probably be some Fed speakers as well. I'm not sure if anyone's paying attention to it at all, but CPI came in extremely cold yesterday. It doesn't mean PPI will, but you should assume that it will, especially with oil dropping the way it has. PPI tends to be a predictor of CPI. So this PPI will predict next CPI if you want to look at it that way. Okay, let's do a summary and final market check before moving to the premium section, which will discuss gold's logical destination. We will touch on in the chart section gold's logical destination. You can see it right there. There's a glimpse of it. Measured move to 3,400 analysis and 3,600 to 4,285 targets explained. That's what we're going to be discussing in premium. But before we do that, let's give a little quick explanation. There's the gold chart. It's a daily chart, squished up a little bit so you can spread out a little bit. You may remember those measured moves that we talked about in silver. We have had many measured moves in silver that worked, and the most recent one did not. We said yesterday on yesterday's broadcast that if gold makes a new all-time high, we're going to buy it, and we did. We bought it primarily we bought some calls on gold, and we added a significant portion to our GDX position. The gold options are for a trade. If gold backs off, we're not going to worry about it. The options will just go out worthless. That's our stop out. The GDX is a long-term hold, meaning if stocks drop, we'll sell the S&P 500. If stocks rally, we'll do nothing. So that's what we're doing there. We're averaging into a bigger long-term macro position. So miners are undervalued. They're still undervalued. And when they become fair valued, it won't stop. And that's indirectly what we're going to cover today in the premium section, which is going to discuss ETF purchases and how that's going to change the market that we currently see. And we're seeing that change come in right now. Moving to other markets. All right. Top right-hand side, that's gold. We just looked at that. Lower right-hand side, that's the dollar. That's the daily dollar. It's down, but it's off its lows. The S&P 500, lower left-hand side, very whippy. Some really good traders that I read and listen to said that they think the S&P 500 low is in for now. They are not bullish. They basically say whippy and wide over until the next definitive American news item comes out. So if China says something bearish for US stocks, we're not going to let it go much lower. And the reason that they say that is because Trump pivoted with the back off in tariffs after stocks made that low and after bonds made that high on the yield side. So they believe that that's where the action is. Who acts next? Well, the president acted, so call that the executive pivot, right? Will the Fed pivot? Probably not. They're not going to lower rates. I don't think they are. But I'm beginning to think QE is on the table again. They may not call it QE, but you need someone to buy our bonds, and that's what QE does. It buys bonds. Uh, will there be a fiscal pivot, a treasury pivot? Yeah, there will be. It can come in any form. It can come in a form of uh, raising the debt ceiling when that conversation comes. That's a fiscal pivot. Just raising it and saying we don't care, we're okay, right? That's a fiscal pivot. Announcing tax cuts, that's a fiscal pivot. Stimulus checks, fiscal. Doubt it'll happen, but you get the point, right? That's it. Top right, top left-hand side, that's a chart of gold versus Swiss franc. I am fond of looking at gold versus silver, saying that silver will rally. And after gold rallies like this, and then silver starts to catch up, that's actually a sign of potentially the market rally ending. It's kind of like the high beta market catches up, gold's overvalued, silver's undervalued, I'll just buy some silver. And so that's actually a sign of money being running out, being allocated. But this is not allocation, this is fear. So I'm not paying attention to my silver thing. And then a thought came to me and was bolstered by a Goldfix founder. I won't say his name. You may remember when this rally, well, this leg of the rally started, we made a comment. Or actually, we were observing something that Jesse Colombo had said, and he said, it's not really a rally. It's not really bullish until the gold market gets above basically all the BRICS currencies. So it has to break out among all the other currencies, and that was a good analysis. Because we had noticed that gold would break out in the Aussie dollar and all the whole epicenter of China and kind of spiral outward until it hit the U.S. And historically, when it made new highs in the U.S. dollar, then that was a sign for the Fed to come in and smack it one way or another. Well, so we're going to add it. We're going to add a flip side to that. If the gold market rally starts with breakouts technically against every BRICS currency, then the gold market ends the rally in a crisis when it goes up against every G7 currency. So what do I mean by that? Well, that's the Swiss franc. And it was actually in our chat on Substack. We were talking about currency moves. And although gold has made a new high against the Swiss franc, you can look at it here. And you can see clearly, this is gold in Swiss franc terms. Gold has dropped. And that's because while most of Europe is pulling their money out of dollars in one way or another, they're putting their money into Swiss francs before they put their money into gold. So they haven't given up hope yet. Capitulation in Europe comes when gold goes up in dollars again. So I would say that we're $150 away from gold being done based on this chart alone. It's a very quick back and napkin type of way to look at it, but I think it's a really good bookend to the whole. If you're going to start buying gold when it breaks out against the BRICS, it has to break out against all of them. If you're going to stop buying gold well, then you stop it when it re-breaks that in the crisis against all of the currencies in the G7. And I think that's a nice little, I like that. Okay, so that's it. All right, so we're going to go into the premium section in a second here. As soon as I can find my graphic. There we go. All right, so we're going to talk about goals, logical destination. Stay with us if you're a premium subscriber. And if you're not, well, we'd like to have you on board. The premium section will be starting now. All right. Okay, everyone. Hopefully you're not here for the production value. All right, goals, logical destination. I'm going to whip through this because there's a lot of information out there on it from us. First of all, see that there? That's the PDF. TDA NAM. That's the PDF, and that's the news stories. It's like the Wall Street Journal. Okay, there are 2 points we want to make. The first point is very simple. Depth equals distance. So here's the V shape that we talk about a lot, and there's the V shape replicated. That gets us to a little under 3,400. It's not precise. It's accurate, but it's not precise. So if you're asking, how does it work? It works like this. Why did I lose my place? It works like this. When I get a signal for the types of things that I do, I'm interested in 3 exits. One is the profit, one is the stop loss for money, and the third one is time. I don't like to be in trades more than 3 or 4 or 5 or 6 days or candles. Could be months, but it's 3 or 4 or 5 candles. And the reason for that is I find that the analysis that I do is very volatility and momentum oriented. So if the market doesn't do what it's supposed to do in 3 to 5 or maybe 7 days, then I will get out. I will get impatient. So how does that describe this? Well, you get your V-shaped bottom. Here, I'll bring it up here. And you'll understand the logic of this. You get your V-shaped bottom, okay? And you say for your analysis, or I say because of my analysis, above here, I'm bullish. And I think depth equals distance. Why? Well, it's pretty simple. Anyone who sold it here, if they're going to cover their risk, is going to buy it above here. And in doing so, depth equals distance. It took this much to get it lower. It'll take that much to get it higher. In a bear market, depth does not equal distance. They can cover in one day. But in a bull market, it's going to possibly exaggerate. But you look at the depth, you measure it higher. It's very simple. It's called a measured move. Look it up if you want to find a little bit more about it. Now, in a measured move in a bull market, which is what we're in, a measured move higher, you say, well, it's got to happen soon because we have everything on our side now. So if it doesn't happen in 3 to 5 candles, right? How did it hit 1, 2, 3, 4, right? 1, 2, right? So 1, 2, 3, 4. So now you get back up to here. So now you say, let's say they cover reverse. It's going to be 1. We'll call this 1, 2, 3, 4, 5. So in 5 candles, we should be at 33.90, right? That's the fantasy, but that's how it works. So I bought it yesterday. Okay, I bought it right at the top here, right? Let's assume that I bought it right at the top here. Okay, I bought it. I kind of front ran myself here a little bit. Right, so I bought the calls when gold was trading here, and I bought the GDX when I was trading here. Okay, so as a trade, what are my stops? My stops are, and I was right? My initial stop was here. Okay, my initial stop was I bought it here, and my initial stop is here. So I went with the wick when I entered and the body of this candle. This candle is very important to me. The wick for the entry and the body for the stop loss. That's my stop. It remains my stop for now. Okay, so that's my first stop. If the market gets below here, I'm out. That's it. I'm out, right? That's why I bought calls, because if I'm out, I don't want to have to worry about it because I'll probably be freaking out about the GDX that I bought. Okay, now that's the first exit, stop loss. The second exit is target, 33.90, right? The third exit is time. If we're 6 days into this and the market is here, right? The market starts to, do shit like this. Here, Maybe I can draw this. Have I got any good at this? The market starts doing this. Well, your signal is going to dissipate. Okay. And yes, could we do this and then go up and hit my target? Yeah, but it doesn't matter. See, the signal is supposed to do that. Boom. Right? It's supposed to be a big check mark. Right? And if it does this, well, now you're just playing coin flips. It could easily do that. In fact, isn't that what happened with the last silver one I had? Right? It did this. It retraced. It held. I was happy it held. Right? And then it just crapped out. Right? Didn't work. Didn't work. So these work over a shortened time frame. So stop loss, target, and time frame. How many candles should it be? 3 candles, 5 candles. You should optimize it. Check for yourself. That's my comment there. Moving on to the next part. Pulling it up. All right. Let me get rid of this drawing tool. Okay. The next part I've already talked about, so I'm not going to get too much into it except to say this. The ultimate upside for this chapter, I don't know when this chapter ends, is 3,600 to 4,285. And I'll explain why. Those are targets that I came up with. And I came up with them after gold broke 3,000. Right away, I came up with these targets. And I have been reading a lot of reports and sharing them with you that the banks have pretty much started to come on board with the concept of catching up with us. Or let's be honest. They knew it the moment I knew it. I'm a trader, right? They're a trader. Let's say that I'm a better trader than them. I don't know, but let's just say that I am. Doesn't matter. They have better information than me, right? They got that information a month before I saw it. And so while they're not sharing it, they're thinking about it. So they started divulging. They started basically saying, we have now quantified central bank buying. Boom. We believe this amount of buying equals that amount of price change. We have now quantified that there's no selling. Boom. We did that as well, right? And what we didn't quantify, but what they started to say is, over and over again, you started hearing this. It's a Western market now. If the ETF demand comes back, gold's going to go up. The ETF. So basically, the market has stabilized because of the central bank and sovereign demand. Well, then the insurance thing happened, which is more sovereign demand. Again, they underestimated how much demand there was out there. But the ETF buying thing was very interesting, I thought, because let's face it, Western investors are fickle. Oh, dollars up, sell gold, shit like that. And I also could not help but fear from my historical understanding of how banks work that they were saying ETFs are going to buy it because their macro discretionary funds wanted to puke and take some profits. Okay, so here I am looking at the whole cynical version of it. And then I said, well, how much ETF demand could there be? And then it made sense. So gold's logical destination is based on the following. Assuming no significant decline in central bank buying and no increase either, price will increasingly track global ETF purchases. ETF buying and selling is the variable now, right? Until a meteor crashes that, gives us free gold. Therefore, next time ETF money approaches levels seen in July 2020 or February 2022, we should see an additional $600 and possibly $1,285 on top of current prices. This is what I said then, ridiculously conservative and therefore a high value estimate. Of course, we're analyzing our own analysis, but placing the price between 3,600 and 4,285 if those ETF levels are reached. So circumstances matter. It must be noted ETF buying will be even more panicky in getting to those prior levels if stocks are dropping, like now, implying much more impulsive moves and likely massive price rallies in miners. Again, this is why I started buying miners. So what am I talking about in pictures? The left-hand chart is ETF demand during the period July of 19, the first rectangle, to the right, January of 25. And there are 3 rectangles. This is my first cursory analysis. And these are the peaks. The peak ETF demand, who bought ETFs, is in July of 2020, COVID. And then the next lower peak is in February or March probably of 2022 during the I almost said Iraqi war, during the Ukraine-Russian beginning of the war. And so you look at the right-hand side, I mapped what gold did during those times. Same rectangles over here. And gold rallied $600. Okay? Maybe it didn't rally $600. I measured it 2 ways. I measured it in terms of actual distance, in terms of price, and then I measured it in percentage terms. Okay, right. So gold rallied $600. So there's a $600 rally basically coming in. I basically pulled this price in here, right? I'm giving you how to do this because I don't want to explain it anymore. I'm telling you guys how to do it. This is how you do it. Okay, this is the analysis is all rote, right? It's the idea that I claim, right? You guys, I want you to be able to do this shit. Okay. So I went, all right, $600 from here to here. Well, if everything remains the same, ceteris paribus, whatever the word is, well, then if the ETF demand comes back from here and goes back up to there, it should add $500, $600 to it. And so the next picture, so I overlaid it, next picture, right? It's like, oh, this is what gold did to here. And I took that and I extended it from here, not from there, from here. And I said, okay, this comes in, then that extends gold above 3,000 to 3,600. Now, why did I say 4,285? Because it's a wide range, because 3,600 is a $600 move. 3,600 goes from this rectangle to that rectangle. But from this rectangle to that rectangle, in percentage terms, adds $1,285 to it. So 3,000 to 4,285. So if we get 600 higher, if we trade 3,600, then we're done. Anything above that, we're going from a notional move to a percentage move. And a percentage move is factoring in things like stochastic processes, hype, marketing, as well as genuine panic. So do I think we'll get there? I don't know. I'm not going to give you, do I think, I have my trades on, right? I don't know. Here's where I launched that. That was like a little over a month ago. Gold tops 3,000. We project where it's headed. The video recording, I did a longer video recording of that. I would suggest you look at that if you want to think about it for yourself. Now, the final thing I want to say is, and this popped in my head this morning. If I'm saying to myself, the Fed can't ease, because if they ease, it'll make the bond market collapse even more in this environment. Remember the whole worst case scenario? That's true. What can the Fed do to help the situation? Well, the Fed can buy bonds. Well, what is buying bonds? QE. The Fed can do QE. The Fed can say, we're going to stop QT and support our own bond market. And we're going to do that by buying bonds and then financing it. But like, it's not yield curve control, but it's related. So basically, QE is on the table now. And cynically speaking, yeah, that's just kicking the problem down the road. Yeah, it is. But I'll say this to you as a patriotic American. There is nothing more bullish for a country than a country that's willing to buy its own bonds. It's like buying your own stock back, right? Now, I know that I'm spinning it in a positive way. I understand that. Buying your own bonds back because you suck, and you want to win an election, that's what we're doing now. But buying your own bonds back because you need to, well, that's true. But what we need to do is we need to buy our own bonds as a people, as well as a government. So when the government says QE, they should do, this is why China's ahead of us now, guys. China's ahead of us because we are, ideologically speaking here, I'm speaking to my students at UConn. China is a capitalist nation. Don't tell me they're communist. That's bullshit, okay? They're communist ideologically, but not economically. The U.S. is capitalist. The U.S. is a democratic governance. They are an authoritarian governance. They are an aircraft carrier. We are an aircraft carrier. Their aircraft carrier turns faster into water because their people are not allowed to dissent, right? They say, we're going to do it. We're going to do it. And in turbulent times, authoritarian leadership is what you need. The question is, how good is the leadership? Well, we have increasingly authoritarian leadership. Our presidents have more power. Executive orders, whether it's Trump or Biden or whoever you want it to be. The problem is our presidents are 4-year presidents. You have authoritarian leadership in China, and Xi's probably president for life now. I don't know. I don't know how it works, but I do know this, that the power in China isn't every presidential election. The power is the party leaders. And yes, they are communist in an authoritarian sense, possibly Stalinist if this continues. But the West is moving towards authoritarianism, while the East is moving towards governance, and the East is moving towards capitalism. They're meeting in the middle. We've been trying to get them to be democratic forever, right? And usually we get people to be capitalist, and democracy follows, right? And so China has said, okay, we'll do capitalism. We see what Russia did. They fucked it up with their they had I think it was called a special region, SEP, I think they might have called it, and it didn't work out. So we're going to do an SEP. We're going to do it better, right? China learns from everyone else's mistakes. That's their nature, right? And they're like, we're going to do capitalism. And every time we had a color war in China, they squashed it, they squashed it, they squashed it, they squashed it, right? Okay, so China's like, democracy's not happening. You're going to go authoritarian. And that's what the rest of the world has been doing. You have to go authoritarian. You need in a crisis, you need a Caesar. Isn't that the whole point? You know, I think it's like a scene from Batman. That's the whole point. It's a republic, and then you appoint a Caesar to take the position during the crisis. Problem is, Julius just never gave up the position. So that's the whole point of this. Can democracy win? Meaning get into China? You know what? If we have a major crisis here, China's going to have a major crisis too. We're decoupling policy-wise, but we're not decoupling economically. You know, there's still a connection there. So I frequently say that, you know, China has had a horrible economy, and they're prepared to deal with more pain than we are. Well, there's a flip side to that coin, and the flip side is, you know what? Historically, economies that are out of the shitter and on their way up, they tend to not want to go back. So the beginning, glasnost in Russia, right? Glasnost was, or perestroika, I'm not sure what the word is, but the opening up that I forgot his name already. The guy before Yeltsin. The opening up of the economy, the guy with the wine stain on his head. Jesus Christ, an important guy too. That was like a taste of it. And so democracy followed, you know? So maybe China's going to get democracy too, but I'm on another topic here. The topic that matters to you, while it is, I think we're going to 3390. And you know what? Here we go. We're going there. Why did I bring up QE? I brought up QE because if QE happens, that's going to support our bonds. It's going to support our stocks. And what do you think the West is going to do when QE happens? The story is going to go from crisis to inflation. And so the West is going to go out of tech stocks into gold stocks. And that's why I bought GDX. I'm Vince. Have a great day.
Well, thanks for watching this morning's Markets and Metals with Vince Lanci. We sure appreciate you tuning in and starting your day with us here. Hope you enjoyed the show, and we'll see you again next week. Please note that this video is not intended as legal licensed financial trading advice and is to be used for informational purposes only. Please contact your financial advisor before making any decisions, and thanks for watching.